Kingsview Asset Management CIO Scott Martin and Optimal Capital Director of Strategy Francis Newton-Stacy are both here. Welcome to you both. Scott, let me begin with you. Your reaction to the Fed governor's comments. She said they could even hike rates.
That's something, I guess, actually the market needs to come to grips with. Now, Ms. Bowman may be trying to steal a headline or two on kind of a slow news day, at least an Nvidia news day, as you let in the intro there. But look, the reality is the Fed should be saying that. And that's one thing that I think the market all year actually has been getting offsides, or at least experts have been offsides on this prediction, which is that at first we were going to get 6 cuts, then 4, then 2. As you know, my mantra has been 0 this year, and that is a good thing. If the Fed has to come in here and cut rates, boys and girls, there's probably something wrong, or something is, say, overheated, or frankly, something, say, has overheated on the economy as far as that, or let's say something has maybe slowed down in the banks, and that's not what we want. So when the Fed says, hey, we might raise or we might cut, that's actually a great thing because the market can realize Fed rates staying right here with, by the way, Ashley, open market interest rates falling over the last couple months as we've had pretty benign inflation data is already doing the work for the Fed. Yeah. So they actually don't have to cut by the end of the year.
Francis, your take? Have the markets been very complacent? And to Scott's point, I think there were as many as 7 rate cuts being predicted. Now they're thinking maybe in September. That would be the last opportunity before the November election. What say you?
Okay, so it's always really a lot of fun to debate, Scott, but I actually agree entirely with you, Scott. The thing is that the Fed, the Fed doesn't need to cut rates because we have relative stability, even that we have softening inflation. And as Scott said, this is beginning to be priced in. And, interest rates are traded via bond market dynamics more than they are with the Fed. The problem with the Fed is that you have to have 2 governors say something dovish and 2 governors say something hawkish so that you balance out, so that the markets don't wildly try to parse through the Fed data and creates volatility in the rate environment. The other thing is that Bowman, talked about some risks in either a continuing of inflation or a reversal in inflation, and those risks are owner's equivalent rent, which has a huge lag going into CPI and is a third of CPI. And it's also the Shanghai, container freight index or freight container index. And that's up 240% year over year and has a massive lag. So it's easier for them to say now that, sort of introduce this conversation about a rate hike when they see genuine risks in the data.
I got 30 seconds from both of you. We're heading into the third quarter, kind of the summer doldrums a little bit, Scott. How do the markets play out from here? Still a ton of cash on the sidelines. We know that. We also have a presidential election hanging over us.
Yeah, trillions, in fact, Ashley. And it should be summer doldrums, but in fact, we're seeing wild volatility swings in some of these individual stocks, depending on what you follow. So I think it's more of that kind of mantra, as far as it's more of that scenario where stocks are going to go up, they're going to go down, but they're going to be more volatile, especially as some of that cash comes off the sidelines and then goes in and then goes back on the sidelines as investors decide here at these lofty valuations what they're going to do into November.
And quickly, Francis, these markets have just continued to grind higher. Do you expect that to continue?
Yes, because there's plenty of liquidity. The fiscal spending hasn't slowed. The private credit interest hasn't slowed. But I will say one more thing about rates. The Fed has incentive to keep rates high, to keep demand in the bond markets, to fund this debt and these deficits. And so that's an important factor that many people don't comment on.
All right, Scott and Francis, stay there. Francis, you will get to debate Scott again a little later in the show, a little later on in the show. But we'll bring it on. Stay right there. Nvidia rallying and rising out of correction territory after yesterday's nosedive that wiped out more than $400 billion from its value. Let's bring back our market watchers, Scott Martin, Francis Newton-Stacy. Thank you both for sticking around. Francis, I'll begin with you. Are we seeing some signs of exhaustion in the big semiconductors, in particular Nvidia, or is this just a healthy pause and now they can move to the next leg up?
Well, the thing is that generally speaking, the fundamental story is very, very strong because there is a tremendous amount of demand for their chips, and they have locked up the intellectual property that will keep competitors at bay for a while. However, on the flip side, Nvidia has become the panacea for all other, making up and and compensating for all other stock market and labor and growth and inflation risks. And to that extent, it could become very frothy because it's just gone up on an unsustainable angle. And that's why things sort of revert back to the mean so that they can kind of get into a more sustainable rate of growth.
What do you say, Scott Martin? A little frothy?
Just a bit, Ashley, on my coffee, like I said, I talked about this morning earlier. I'll tell you, I mean, damn, I can't disagree with Frances here either. I think she's correct. I mean, she mentioned fundamentals. How does 150 or so % revenue growth sound? How does 120% free cash flow growth sound? How does net profit margin, Ashley? All these fun things to talk about with people at bars. So how does net profit growth at 200% sound? That's Nvidia, boys and girls. The problem is that the stock has gone crazy, and it's lifted a lot of other stocks for no reason other than it's just Nvidia. And when you have clients, Ashley, that are both clients of our firm and ones that are looking to join us saying, hey, how much Nvidia are we going to buy? And like the first 10 minutes of the conversation, that tends to remind me of, say, 2007 and 1999, when some of those stocks that were high flyers and so great and can't misses started to turn over, and to your word, started to get fatigued, and therefore times to start to lighten up.
Yeah, Francis, yesterday we saw a lot of that money coming out of Nvidia and other semiconductors and going into, what, energy and banks, which overall, isn't that healthier for the market to have a more broad-based growth?
It's definitely healthier for the market, but just in the interest of sort of debating this issue, Nvidia, it's a fabulous company, but the rate at which it's expanded is just kind of unsustainable going throughout. And global macro always trumps stock fundamentals, right? And so if we have something change with inflation, or we have something change with growth, or we have credit problems, Nvidia, despite the strong fundamentals, will definitely sell off. And so you just kind of lower your risk by rebalancing when things get a little bit frothy. And it sounds like Scott's having these fun conversations with clients as we are.
Very quickly, Scott, is there anyone else in that space other than Nvidia that you like? Because it gets all the headlines.
Yeah, it's funny, Ashley. I mean, ones that we've recommended just on the side, like I said, as Francis said, too, to take off a little bit of the froth, to use that word for like the fourth time off NVIDIA, is like, look at AMD and look at Taiwan Semi. I mean, these are companies that have valuations that are like 1/5 of NVIDIA and still have a great business, but are not as popular as NVIDIA, but ones that could catch up easily as some of the regulations come in, as some of the market volatility goes up, too.
Very good. We'll leave it there. Scott, Francis, a very frothy conversation, which we always enjoy. Look forward to next time. Thank you both. Meanwhile, back to Earth, home prices rising more than expected, up 7.2% annually in April. We just can't seem to crack the housing problem. I want to bring back Scott Martin. We just talked at the top of the hour, Scott, about the Fed's Michelle Bowman, so we may have to raise rates. Well, that's certainly not going to help the problem, is it?
It shouldn't, Ashley. I mean, speaking of home prices, speaking of out of this world, let's look at home prices in the U.S., and here we are. Enjoyed that interview, by the way. And maybe Mars and the moon are the solution, Ashley, because if you notice one of the issues that's going on in the housing market in the U.S. is supply. The problem is with the data out there, which, by the way, Ashley, in May, we saw median home prices, meaning the midpoint of the frequency of distribution of home sales in May was $419,000 for the median home price in the United States, which is unbelievable, all-time record high. So when you don't have a lot of sales out there, Ashley, because of interest rates, because of the fact that supply isn't very strong, that tends to distort the, say, the overall averages, and therefore I think that's why you're seeing housing in a little bit of this weird state where we're not sure what's going to happen despite what the Fed wants to do or doesn't want to do.
Got about a minute left, Scott, but we ask this question a lot. Is the American dream dead right now? It's almost impossible, especially for first-time home buyers.
Yeah, that's about 59 seconds more than I need. And the answer is yes, for now. Now, the good news is about America. The good news is about capitalism. The good news is about maybe getting a shift, oh my goodness, in D.C., the American dream can come back. The trouble is, if the government, something you said to a guest earlier this hour, Ashley, if the government can just get out of the way and not try to screw around with interest rates, not try to screw around with all these mortgage applications and promos and all this stuff, and let the banks do the banks' work, let the Fed do the Fed's work, let the government do whatever they do, protect us, I guess, as far as security goes, certainly maybe against China as we fight them for space on the moon. That's the area where I think the housing market can really come back and deliver itself for that American dream for the college graduate and for everybody else who's waiting out there to buy their first purchase.
An out-of-this-world report from Mr. Martin on the housing market. As always, thank you so much, Scott.
You can count on me,
Appreciate it.